Good afternoon, everyone. It's my pleasure to welcome you today, and I'm going to go ahead and pass it over to Laura from HUCTW to talk a little bit more and intro this.
Great, thanks, Sarah. First, I want to say thank you to the credit union, the Harvard University Employees Credit Union, for our ongoing collaboration, allowing us to have seminars like this to help our members save money. This particular seminar is about home loan refinancing. And for some reason, I just blinked. Home equity loan, someone help me out.
Line of credit. There you go.
Thank you. So we're going to turn it back over to Sarah and to the other folks at the credit union to talk to you more about those details.
Thanks so much, Laura. We're so glad to have you all here today. Like she said, she is on and she is a part of HUCTW. So if you do have any questions that may relate to that, you can put them in the questions feature. She does have the ability to see those questions if anything does come up. But of course, we here from the credit union are talking a little bit more about this subject today, home refinancing and HELOCs, or home equity lines of credit. In the banking world, they're very known as their HELOC name, right? Just like we have in higher education, there are a ton of abbreviations to things in the financial world as well. So HELOC is one of those. Some logistics before we get started on our topic. We've gone ahead and muted everybody on the call except for our presenters. So this way, hopefully you can continue doing whatever you need to do during this hour. That may be eating lunch. It may be, background noise that's happening in your home or in your office. That is totally fine. You're in a quiet place. And then using the chat feature, we've gone ahead and added the chat feature here for everyone. The questions feature is on the right-hand side of your screen or at the top navigation. So this way you can ask us questions without having to speak on camera or anything of that nature. So if you could go ahead and let us know that you can hear us by putting in the questions feature where you are joining us from today. Where you are joining us from today. Great, I see some people answering that question for me. Some people are joining us from the medical school, Cambridge, the School of Education, the library. Wonderful. It's great to have all of you. HKS, wow, we're going to have all the schools represented. Love this. Thank you so much. I'm joining today myself from Somerville, Massachusetts, so extremely close by. Campus services, wonderful. Thank you all so much for this. It helps me to know that you can hear us, and it also helps me to know that you know where the questions feature is. So if any HLS, okay, we really may have all the schools represented now, but I hope that you all will ask questions throughout if anything does come up. We've gone ahead and started recording our session today, so that way you all will have access to the recording. We'll be sending an email probably on Friday, as we all have off tomorrow. So I'll be sending that email on Friday so that you all have access to the recording as well as all the slides. So if any questions do come up after, you want to take a look at something again, you'll have access to that. We do ask that you take a short survey for us during our time or after our time today. It is about 5 minutes, not long at all. I think maybe 3-4 questions, but this just helps us to know if this was a topic that was interesting to you all. If there's something else you'd like us to cover, we are happy to do so, and we definitely take a look at those surveys every time they are done. So we appreciate any time you can offer for us. Harvard University Employees Credit Union is Harvard's not-for-profit financial institution. What does this mean? It means that we are a financial institution created specifically for our Harvard employees, Harvard affiliates, whether that means that you're in Cambridge or maybe in the medical school, in LMA, maybe even another state. This is because we create products specifically designed for those in our community. Not only that, we also focus directly on this community when thinking about giving back and thinking through those decisions we're making. And you can access us anywhere using your mobile app or the online banking feature. So even if your professional career ends with Harvard, you are still a member of the credit union if you joined while you were an employee. And as employees of Harvard, all of you are eligible to join the credit union. And so if there are any questions about that, we're happy to answer any of those as well. One way that we are helping the community this month is through our Matching Miracles program. We have started this program in partnership with the Children's Miracle Network. And for any donations made through our giving link or through your online banking, if you are a member, in support of the Boston Children's Hospital, will be matched up to a total of $2,500 throughout the month of November. So if you and your families are thinking about giving back these holidays, this is a really great opportunity to give back to the Boston Children's Hospital right in our community. Now I'm going to introduce you to Helen Lascaris. She is one of the mortgage loan originators at Harvard University Employees Credit Union, and she will be talking us through home refinancing and HELOCs today. So Helen, the floor is all yours.
Thank you, Sarah, and welcome everyone. I would like to go to the next slide. I work out of the Mass General main campus office, but myself and my colleagues, there's 5 of us, we are available to you wherever you are. We have a lot of remote options, and we're welcome to meet with you as well at any of our locations. So the 2 things that have happened, I think, and the reason why everyone's here today, in the past 2 years, interest rates have gone down and property values have really increased. So if you're a homeowner, that's opening up some opportunities for you to tap into the equity that you've built up in your home, or to also maybe lower your interest rate. So I want to talk to you today about the products we have at the credit union and that are available, with other lenders that would give you the opportunity to do either of those options. So we'll talk about the refinance, which is replacing your current mortgage, or the home equity line of credit, and there's also a home equity loan, which is adding a second piece and leaving your mortgage together. So either way, depending on your goals and an analysis of your individual situation, those options may benefit you. So we're all looking to either save money, pay off our loan early, and there's a host of other very individual goals that people have. So let's go on to the next. I want to try and start talking about what the options are. So you own your home. What options do you have? Well, the one option is to do nothing, just continue along the path that you're on, making your monthly payments. If you have additional money, you could keep the loan you have and just make extra payments. And I think in most cases, I know on our mortgages, those automatically would go to principal, and then you pay your loan off sooner. You could borrow against the equity, the available equity to you, and I'm going to talk about how to figure out what is the equity I have available through a HELOC or a refinance, where you can change the terms of your loan. There also, if you own a home and you're thinking of retiring, we don't offer reverse mortgages, but that's an option. So you have all this equity, but you can't afford to be making monthly payments. So in a reverse mortgage, the lender is actually paying you monthly and based on your equity. And those are very specialized, and they always have an exit plan for you, and you should really be careful if you're interested in that. But if all the other mortgage products do rely on income to qualify, except for the reverse mortgage, that's strictly relying on your equity. So I'm not going to talk about the reverse mortgage, but I'm going to talk about the other options that you have to tap into your equity. So let's move on. So one option a lot of people are doing right now, and I know you've seen it in the news because it's all over the news, is refinancing. So let's talk about what refinancing means and why do people refinance their mortgage. And that means we will extinguish your current mortgage and replace it with a new mortgage. Well, they want to either reduce their monthly payment, reduce the term of the loan. Sometimes people are extending the term of the loan if cash flow is a priority, reducing the payment, the interest rate. And there's a lot of reasons. They need money to improve their home, or they want to improve their home, or other reasons that people need funds. Could be debt consolidation. And here's the big one, that if you have private mortgage insurance right now, I recommend talking to one of us, because the explosion in value has maybe given you the option to remove that payment. If you're paying $200 a month in PMI or private mortgage insurance, that could be deployed to principal, it could be deployed to investing, it could be deployed in other areas. Now, on conventional products that we offer, we can remove private mortgage insurance. There's rules on an existing loan. On some other products in the marketplace, like an FHA product, I think PMI is on that loan for life, and you would have to refinance to remove that PMI. But I've had a lot of people that just bought fairly recently and are removing PMI. I mean, it's really exciting. And if you have PMI, I would urge you to contact me or one of my colleagues and let us look into it for you. So let's go on to the next slide. So there's different options to refinance based on your goals. You can do a straight rate and term refinance, which that means you're not looking to get any additional funds. You're not looking to tap into the equity, but you're looking to take advantage of the lower rates. So maybe you can go from a 30-year fixed to a 20-year fixed or a 15-year fixed, and your payment might not increase that much. Likely it's going to increase if you're doing something like that slightly, unless your rate is super high. But, you know, you'll benefit by the loan ending sooner. Or the cash out refinance is that you're tapping into that equity. For example, if you have a home worth $500,000, you can borrow up to $400,000. So if you have a loan of $200 right now, you could take a cash out another $200, and you would go to a closing and you would get $200,000 and have a new payment on your new mortgage. Your current mortgage would be paid off. So we have both options. A lot of people are doing cash out right now for home improvements. That's one of the major reasons, and debt consolidation, which I really want you to be careful. If you're doing a lot of debt consolidation, if you're finding that's the purpose of the refinance, I'd want you to do a budget too, and just let's go through it, because it is a serious thing to, you know, tap into the equity. We think property values will keep appreciating, but we don't really know. So we just don't want you to, and we've seen it happen, unfortunately, you know, every couple of years people are trying to do cash outs for debt consol. I don't want to see you have to do that. So we have a lot of resources, Green Path, that can help with a budget and pick the right product to help you with your overall financial situation. So let's go on to the next slide. So let's talk about the cash out refinance, which we're doing, as I said, a lot of for home improvements. And look at this beautiful kitchen. I told Magdalia, I love that photo. I want my kitchen to look like that. But common reasons that people are doing cash outs, as I said, home improvements, life events such as a wedding. An unfortunate life event is like a divorce. So if you own that happens, if you own a home with a spouse and then you're separating and that person is no longer going to own the home with you, you have to refinance to remove them from the deed. So we do a lot of that, unfortunately. Medical expenses. Some people just want a cash fund and feel the rates are so low, I want to have some money set aside. They use the cash out for that. You should always consider, you know, taxes. Consult your accountant or financial advisor. We cannot give tax advice, but the interest on mortgages can be tax deductible, can be a benefit, and some people are refinancing for that. A lot of people are looking to trade up. We have that a lot, and they're refinancing to tap into the equity. A lot of people are using HELOCs for that, and I will talk about that later. But you know, if you're looking to trade up your property, it's really hard to get your offer accepted in this market if it's contingent on the sale of your home. I need the money, the equity in my home for the down payment on the new home. So you want, and the only way that you can get that is by selling your home first. So that contingency on a pre-approval is not viewed favorably in a seller's market. So as long as you can qualify, if you can tap into that equity in advance so you have it there when you need it, you can put an offer in without it being contingent on the sale of your home because you've already extracted that equity and you have it ready. So I would say out of all these reasons, the home improvement and purchasing either a second home or trading up are very, very common and are happening a lot right now in this market. So let's go on to the next. So, you know, you need to determine how much equity can I borrow? I mean, we don't let you go up to 100%. Typically, if you did a refinance with us and with most lenders, we are going to conduct an appraisal. So we're going to send someone to your home to do an appraisal, and it's going to be based on what's sold in other homes in the neighborhood or in the area that are like your home. We typically can go up to 80% of the value of that home. Now, if it's a jumbo loan, which means if it's a loan that's over, $724,000, we only can go up to 70 on a cash out, 70%. But here's an example of a home that's valued at $650,000. We get our appraisal. 80% of that is $520,000. So that's the most that you could borrow against that home on a cash out or refinance. On a rate and term, let's say you had a home for $650,000 and you owed $600,000. We could consider a rate and term at higher than 80%. But rate and term means you're just keeping everything the same. It's the loan you had when you purchased the home, and you're replacing it because the interest rate is lower or whatever. We could do that even if the loan to value is over 80%. If it's 85 or whatever. But on a cash out, we don't go higher than 80 or 70 if it's a jumbo loan. So in this example, appraisal $650,000, so 80% is $520,000. That's the most that can be borrowed against this home. And then you already owe $275,000 on the current mortgage that we're going to extinguish. We're going to pay that off. So you can do a cash out up to $245,000. So that's an example of how we would calculate how much equity you have available. You might not want that much, and that's fine. So let's go on to the next slide.
Helen, before we
But
go on to
that's
the
how
next,
you would calculate. Yes.
we have a couple of questions that came in. One was, can appraisals be waived and an AVM be used, especially if LTV is around 40%?
Okay, that's someone that knows a lot about the mortgage market. So an AVM is like an automated valuation model. So it's sort of like a computerized appraisal. On our refinances, we follow Fannie Mae guidelines. So what happens is we take your transaction and we run it through their guidelines, and they may say, we don't need an appraisal, and you could get a waiver. We do not use, at this time, AVM, automated valuation on our refinances. We do use it on HELOCs and second mortgages, but so you would either have, in our case, if you did a refinance, a full appraisal or an appraisal waiver. If, we got the finding from Fannie Mae, they don't require an appraisal. So those are the two options. We would know that within a day or two of your application. So let's say you applied and, because of COVID, I don't want anyone in my house. If it's not a waiver, I don't want to do it. You could cancel it, if you decided to. But those are the two options that we offer right now on the refinance. On the HELOC and second, yes, we do use the AVMs.
Thank you. Another question that came in, and I know you'll be speaking to different options throughout, so if it's best for you to defer, feel free. The question was, we have significant equity in our home and would like to put an addition on it soon. Which borrowing option would be best for this kind of goal and why?
Okay, well, I did want to mention one thing on refinance and about home improvement. If we're doing an appraisal on your home, it cannot be in any state of disrepair. In other words, you can't start an addition, run out of money, and then try to get financing. The lender won't do it if the house is, the house you have to get the money prior to starting the renovation. Okay, so in this case, you're starting to do a substantial renovation. Which option would be better? You know, I hate to say that I can't give you a hard answer. I need to know what kind of mortgage product you have now, how long you're planning to stay in the house, how big is the renovation, when is the renovation starting? Is this just an idea, or you have plans, you have estimates, you're ready to go in a couple of months? I mean, so depending on your first mortgage, I would say I don't know, if the renovation is large, you might want to get, if you have a really good first mortgage, a fixed second mortgage for that renovation, because our rates are phenomenal right now. We have a 10-year at 2.75, 15-year 2.875. There's no closing costs on that. If your only need for equity is this one specific product, I would say you're going to do either a refinance of your first mortgage, if your rate is high, or a fixed second mortgage. A home equity line of credit has a variable interest rate, and on a large project, you could be exposed if rates go up, unless you were planning to sell the house in a short amount of time. Then you could do the home equity line of credit. And the reason that you would consider that as an option is you can get a higher limit than what you need in case the costs run over. You can tap into it. The other two options, you have to take a set amount, and then if you need more money after, you're kind of stuck. You'd have to refinance again or whatever. I think I would like to talk to that person and know a little more about their specific situation. But the two options, you know, they could use either option, but probably a refi or a fixed second, I would think.
Thank you, Helen. And as a reminder, we are using today's chat. So for folks that are logged on, if you either look on the right-hand side or depending on how you logged in on the top navigation, I've been putting a couple links. And one of the links that I included was the link to our page where you can schedule a time with either Helen or any of our other mortgage loan originators. Another question that came into the chat, and I will put the answer in the chat as well, is what are the current interest rates on cash out refis? I'll put in the chat the link to all of our rates where you can just view any of our rates if you have any questions.
Okay.
Go
That's
ahead.
a great question. I'm sorry. I'm so excited to answer it. That's why I jumped in. We're unusual in that the rates we post on our website are available for purchase, rate and term, and cash out refinance. Typically, lenders charge a little higher rate on a cash out refinance than they do on a purchase or a rate and term refinance. We don't. So today, my 30-year fixed rate on a cash out refinance is 3%. My 15-year fixed rate on a cash out refinance is 2.375%. Regardless, as long as you have a qualifying credit score, which the minimum is 620, we offer the same rate to all our members who qualify, regardless of whether your score is 620 or 800. So, and regardless of whether it's a cash out or a rate and term. Now, if it's a cash out for a big home improvement and it's over 100,000, we are going to want to know a little more detail about what are you doing to the home, you know, just to make sure that it's not something that would fall under the realm of a different type of product, like what's called a construction loan, which we don't offer. That would be, you know, if you're really tearing the home down or doing extensive demolition to the home, that would be we'd need to delve into that a little more with you.
Thank you, Helen. And the last question. Oh.
I just want to say rates ticked down a little bit. I know it's been in the news that rates are starting to go up, but rates are really good right now. It's another, if you didn't take the opportunity to do something up till now, the window is still open right now. You know, I know they're talking inflation, rates are going to go up. Who knows what's really going to happen, but the window is still open.
Thank you, Helen. And then the last question before I turn it over to you, because I know we're about we have more than half of the slides left. The last question that came in was, can we refinance with HUCTW if currently have a loan with another banking institution? If so, is there a cap to the amount that we can request?
Yes, of course you can refinance with us if you have a loan with another institution. And you know, the cap is based on the percentage on the value of your home. I mean, we go up into the millions, you know, if someone had a home that was worth over 1.5 is called a super jumbo loan, and we'll go up to 70% on that on a cash out refinance, up to 80% if you wanted a home equity product. So I recommend, talking with us because, regarding your specific situation, but we can go up, as I said, to 80 combined loan to value or 80% loan to value, and we go up over 1.5 million. So, depending on the value of the home, we can accommodate you. And these rates are, one thing I want to say, right now we're not financing investment properties, so these rates are applying to your primary residence or a second home, not an investment property. And this whole discussion is not about investment properties. We are going to start offering those again. I've heard in the next month or two, not home equities, but primary refinances or purchases of investment properties will be back in our stable of products shortly.
Thank you, Helen.
So let's go on to the next slide, unless you have another question.
No, I think we'll hold the rest of the questions for later. Thank you.
Okay, so the rate and term refinance, people are looking to save interest on the rate and term refinance. They either, want to reduce their monthly payment and keep the term the same, or reduce the term. That's typically what people are doing with a rate and term. And let's go to the next slide. I have, an example. So let's say, and how do you figure out, is this going to make sense for me? So you look at your new payment versus your existing payment for the same term, and you say, okay, I'm going to save $960 a month, but there's closing costs, the upfront lender fee, that's closing costs. So there's a cost of the appraisal if we'll do it, if you don't get a waiver, there's legal fees, there's other fees associated with refinancing, and we list them all on our website. It's very transparent. You put in your situation, your the value of your home, how much you want to refinance, and you'll see all the fees. But in this example, the fee is $2,500, the closing cost. You're going to save $960 a year. How long is it going to take you to recover or recoup those upfront costs? And that's kind of how you might make a decision as to whether it makes sense. In this example, if you're going to sell the house in the next 2 years, it doesn't really make sense. The savings is never going to be realized. But in actuality, if you were going to stay here for the long term, this would be a favorable situation to refinance. So let's go on to the next example. Another, refinance is people are going to decrease payments. So let's say, for example, in this example, you have 27 years remaining in your term. You're going to refinance to a 1% lower rate. You're going to realize $1,193 a month annually. The closing costs are $3,200. In 2.7 years, I'm going to recoup. My lower payment is going to pay for itself, and I'll be in the green on this refinance. And again, this is a favorable situation for someone to move forward. Let's go on to the next. And sometimes we have a lot of people that are saying, gee, I've got 25 years left on my 30-year mortgage. I want to retire in 15 years. I don't want to have a mortgage when I'm retired. So they're saying, I want to refinance to a shorter term mortgage. Even with lower rates, likely the payment on the shorter term is going to be higher. So in this case, when you're looking at this, your priority is looking at, you're lowering the rate and look at the savings and interest. I'm paying off my loan early. I'm going to save $178,000 in interest, and even though my payment is going up. So you do have to do a budget on this and just make sure that you can afford the higher payment. We also have a 20-year option. So if 15 was too steep, let's look at the 20-year. There's still savings there. So that's another example. When you're shortening the term, you're really looking at the increased savings on the interest over the life of the loan and your goals, how the shorter term dovetails with your goals rather than, having a lower payment. So let's go on to the next. slide. We have calculators on our website. So you can go on the website and you can put in some, your figures and look at how much interest am I going to save? How long is it going to take me to recapture my closing costs? And what would my monthly payment be? And there, if you scroll to the bottom, you could just huecu.org/calculators, or if you scroll to the bottom of our website, it's there too, that you can just click on the link down there. So let's go on to the next. So should you reduce or increase your term? I mean, I want to say everybody reduce their term, but the reality is a lot of people are looking at cash flow and they want a lower payment. A lot of people aren't focused on their term for whatever reason. I mean, if you can reduce your term, you're going to reduce the interest you're going to pay. Your equity is going to build more rapidly because more of your monthly payment is going to be going towards the principal rather than the interest. The rate's going to be lower. And like I said about retirement as a goal. But, things happen. I had a member whose parent was ill and he had to help his father because he was out of work for 2 years, and he built up his credit cards to an unsustainable level. His father's back on track now. He refinanced and he was interested. He increased his term and needed a lower payment. I mean, those credit card debts just happened. It was a life situation. He was okay with it. He just wanted a lower payment. I mean, if you're increasing your term, now is the time, if you have to, only because the rates are so favorable right now. The money is cheap, as we say. You're still going to not pay as much interest as you would have a couple of years ago. So, and it's very individual based on a lot of factors for each person. What's the right thing to do? There's no right or wrong answer. Let's go on to the next slide. So we talked about cash out refis, rate and term refis. So those would be extinguishing your current mortgage and replacing it. Now, HELOC, home equity lines of credit, and fixed second mortgages are another option you have to tap into your home equity without disturbing your first mortgage. So if you bought your home a couple of years ago and you got a really good rate and everything's fine, you don't want to refinance and pay closing costs again, but you'd like to do a project, you'd like to tap into the equity, you have another option, which is a HELOC or a fixed second mortgage. There's no upfront closing cost to you to obtain these products. On the HELOCs, there's a 2-year recapture. So that means the closing costs are about $500. If you close it within the first 2 years, we're going to charge that back to you. If you keep it open, you will never pay closing costs. And on the fixed second mortgages, we pay the closing costs. So that's one difference off the bat. Let's go on to the next because I want to talk a little bit about these products. By far, the HELOC is more common than the fixed second. Why? It is a flexible product. It's a line of credit secured by your home. So if you have a HELOC for $100,000, you have your first mortgage, and then you have this HELOC, which is a second mortgage. They're both second mortgages. You have access to this money. If you don't access it, you don't pay any interest. It's not a fixed rate. That's the disadvantage of it. The rate is not fixed. It's variable at the prime rate minus 0.26. When the pandemic happened, the prime rate dropped to 3.25, and it's been there since. So all our home equity lines are at 2.99, which is prime minus 0.26. You can use it for any purpose. You don't have to take any money at closing. So if you have a $100,000 home equity line, you could use it to pay off some debt, and you could do your roof. It's flexible up to the limit. You can use it for multiple purposes. A lot of people do use it for smaller home improvements. They don't know, exactly how much or when the person can do it, and they have the money ready. The disadvantage of it is that prime could go up, and if prime goes up, then any money you have borrowed, your payment could increase on that balance. The payment you made last month of $120 could be $130 if prime goes up. It hasn't gone up. So that's how the home equity line of credit works. We give you a checkbook at closing, and then you have that, and you can use it when you want to. Let's go to the next. I want to tell a little more about the guts of how the HELOC works. So it's a 25-year product. The first 10 years are called the drop period. That's when you can use and reuse up to your limit. If you have a $100,000 limit, you can borrow $12,000, pay it back, borrow $50,000, pay it back. That's why a lot of people use it to tap into the equity if they're trading up. They have it sitting there. They might not get an accepted offer for 6 or 8 months, or so they don't have to access it, but they know it's there. As you repay, your credit limit is replenished. Following the drop period, which is the first 10 years when you can use it and reuse it, the line shuts down and you have to pay back whatever you owe in the ensuing 15 years. Now, that payment is going to go up dramatically because during the drop period, you only have to pay interest, only required to pay interest. So if you have not been paying principal, then you're going to have a payment shock. And all the paperwork we show you what the shock is in advance. We want you to know if you go into repayment with this balance 10 years from now, this is what will happen. If you sell the house, the line gets paid off and that's it. You never go into the repayment. People who have HELOC do not want to go into repayment. So typically what happens is around year 7, you reapply for a new HELOC for a fresh 10 years to extend that out, the drop period out, and any balance you have on the current one just gets transferred over to the new one. So that's how that works. That could be used for home improvement. It could be used for any of the purposes we talked about previously in the refinance. We do more HELOCs than fixed seconds. Now let's go on to the next. So a fixed rate second mortgage is like it operates like your first mortgage, and it's just a second mortgage that's added. So if you have $100,000 fixed rate second mortgage, we offer terms of 5, 7, 10, 15, and 20 years. Our 10-year is at 2.75. Our 15-year is at 2.875. We have the best rates for these products that I've seen, honestly. And it's a monthly payment of principal and interest, just like your first mortgage. You get a great rate, but you have to take all the money up front and start paying principal and interest immediately. The thing with the fixed rate second is it's not a flexible product. There's no such thing as a third mortgage. So let's say 3 years from now, you want to tap into any additional equity, or you can't. You'd have to extinguish this and then replace it. On the HELOC, you could get a HELOC for as much as you qualify for. If you don't use the money, it's just always available to you. So that's kind of the difference. I would say a fixed rate second is if you're doing a large home improvement project, this might be a safer bet if you're borrowing like $100,000 plus and know you have a fixed rate, rather than, having that money out there on a HELOC, unless you knew you were going to sell. If you knew I'm going to sell this house in 2 or 3 years, then chances are you're not going to take much interest rate risk on the HELOC. You can make the lower payments during that time period, etc. So that's, the pros and cons. I mean, the fixed rate second has the great rate, but no flexibility. You have to take all the money, stop paying interest up front. The HELOC, variable rate, but you don't have to take any money, and you only have to pay interest. There's no principal required to be paid during the drop period. So let's go on to the next. Oh, okay. So this is my first time doing this presentation, so I've reached the end. There was one thing I did want to mention. I did do a little sample for myself. So let's say someone took a $50,000 fixed rate second for 10 years. At the current rate, your principal and interest payment would be $477 a month for 120 months or 10 years. If you took a HELOC for $50,000 and you access the entire $50,000 at the rate of 2.99, your required payment would be $124 a month, which is the interest on the 50,000. So there's an example of, gee, the payment on the HELOC's a lot lower right now than it is on the fixed second. So, but what does the future hold for the HELOC? That's a little bit unknown. So, I'm Helen, Michael, Ryan, Daisy, and Sharon are my colleagues. We work with people talking about refinances versus HELOCs. I mean, a lot of times on any product, we do get your current first mortgage statement. So, if we see you have a 5% first mortgage, we'll definitely bring up, have you thought about a refinance, and review that with you. We'll review all the options and see, which is the best for you. It's about a 45-day process for any of the options that we have. The rates can change daily. You lock it in by going on our website and submitting an application. Are there any other questions, Migdalia? I hope.
Hi, yes, there are, Helen. Before we get into the questions, we have a couple other slides that I just wanted us to go through. And
okay.
as I'm going through
Okay.
these slides, if people do have additional questions, please submit them via the questions panel. We did put the link in the chat, but want to remind you that you can learn more about our rates, our products, contact our mortgage loan originators by going to our website, hucu.org/home-loans. I'm also going to put in the chat our survey. This helps us improve our offerings. We meet with the leadership at HUCTW a couple of times a year to just go through the presentations that we've given, what have folks said they liked, disliked about the presentations, and we've added presentations based off of the comments. So please, as it only takes a couple minutes, as Sarah said earlier, just let us know what you thought. Also, as Helen mentioned, this is the first time that, this is a new presentation that we've added, and this has been a direct result from people asking for presentations such as these. And then we do want to always remind you a disclaimer. Helen did a wonderful job explaining all of the different products and what to consider. But as we know, everyone's personal financial situation will be specific to them, so that we recommend contacting one of our mortgage loan originators, speaking to someone about your specific situation, because what may work for one person may not work for someone else. And before I jump into questions, I do want to remind all of you that you're all eligible to become members of the credit union. And if for those of you that are members, do know that we are currently have a referral campaign, meaning that if you refer someone, you and the person that was referred each receive $50. And we're also doing a $5 contribution per new member to 2 different charities during the month of November. We are giving to the Boston Children's Hospital through the Children's Miracle Network. And for December, we are giving to the Massachusetts Coalition for the Homeless. So if you are a member and would like to refer someone, you can go to hucu.org/referral. Or if you want to become a member and want to get that $50, I'm sure you can find someone who is a member, and that both of you will receive that $50. And I'll start now with the questions that we've received. One question that was submitted was, what is an open-ended mortgage? I've heard of them before. I've heard the term before, but I'm unsure if it's one of the products discussed here, but referred to as a different name.
Yes, so the open-ended mortgage is the home equity line of credit. That would be an example of an open-ended mortgage that, it's got a limit, but it's open. I would refer to that as an open-ended mortgage. The others are not.
Thank you. Another question that was submitted, how do you refinance without points/paying extra for it?
Well, okay, that's a good question. So we do have, what I was talking about in the presentation is options where you're paying closing costs, but you're not paying additional fees to make the rate even lower. So there's the no point option, which is you pay closing costs, but nothing else in origination fee for a lower rate is the standard. There's also options where you could pay even more upfront than the closing costs to get a little bit even lower the rate, or you can pay a little higher rate and not pay closing costs. So we have a no closing cost option and an option with points. Now the no closing cost option is only, in my view, good if you're only going to stay in the property for a short term, because you could take the regular option and include the closing costs, and it might increase your payment by, it's going to increase your payment a lot less than taking the higher rate and not paying the closing costs. So I would run through that with you, but there are options for lowering the rate and paying even more upfront than just the closing costs, and those are called origination fees, or paying no closing costs and you take a higher rate and obtain the loan with no closing costs. So typically it's a quarter either way. I would say as a general rule, we do show those options on our website too. And we put the APR, which is an important term. Rates can be different, but the APR is a term that means how much is this credit costing me, including all the fees. So a lender could show you a really low rate online, but their APR is high. That's a red flag. There's a lot of fees that are loaded into this rate that might not be the best option. So kind of look at that rate also. Wherever you see a rate quoted, the APR has to be right next to it. So rate, APR, the closer they are to each other, the better, the lower the fees are and the better it is for you.
Thank you, Helen. I don't see any questions that were submitted. Oh, I am incorrect. There was one that was just submitted. And this is a really perfect, timely question. I know Helen will have some updates. Is there a mileage limit to where HUCU will offer home mortgage products? For example, we're 45 miles from Cambridge.
No, we used to have that as part of our charter in terms of how far we could be from our main office, but that is no longer. We can finance in other states too. So 45 miles from Cambridge is in our wheelhouse. So we can finance now in Maine, Vermont. We were financing in New Hampshire up to a certain distance from our main office, Rhode Island, Connecticut. All those states are now part of the lending group's refinance territory. So we're able. 45 minutes from Cambridge is definitely in our lending area. So I'm glad that you mentioned that, so I can bring up that we are financing in these other states. So if you have a second home, we can consider doing a refi on that.
Thank you, Helen. I don't have any additional questions that were submitted during our webinar. I don't know if Laura, if there's anything else you'd like to add.
No, I would just, okay. I would just like to reiterate, please let either the credit union or the HUCTW know if there's anything you're curious about in terms of finance, so we can get a good idea of things that we can offer that we're not offering right now. But other than that, I just want to say thank you to the credit union and thank you for all of you for coming.
Thank you, Laura.
Yes, I was going to say thank you too for taking your time out of your day to listen to the presentation, and I sincerely hope that you got some benefit from it.
Thank you, Helen, for all the information you shared. Thank you, everyone, for joining us. We hope you have a wonderful day off tomorrow. The presentation will be made available on our YouTube channel. You'll also receive an email, and I will put our YouTube link in the chat if you would like to subscribe to our channel. That way you can receive notifications. If you follow our channel, it'll appear, and if you subscribe to it. And if there's anything else, always know that you will be able to reach us and can contact us at any point. We hope everyone has a wonderful day off tomorrow, and thank you so much for joining.